As a day trader, we need to have a very good understanding of all the trading strategies, setups, and how they work. One of the good example is the breakout pattern that give you the highest probability of a good trading, so you can make money. How to grasp the breakout patterns? There are a few types of them. One of them is that the breakout is strong, but it developed into a wide range. Let me show you how it works. First, we have a big breakout, like one big bar or even consecutive big bars there, indicating the market is very strong, either going up or going down. And then it follows by a pullback, and then we're expecting second leg up and the third leg up. Even if the first leg is very strong, it doesn't mean the second leg here or the third leg here are strong. We need to tell the market strength as the trend is going on and tell whether it is still very strong or it is weakening. If it is weakening, then our strategy will be a little bit different than the still strong trend. If the market is weakening, normally it's going to develop into a wide range after their breakout, after the three legs here. So you can see that the market goes up very big for the first leg, but the second leg and the third leg are not as strong as the first leg. So this is a very good sign of the market being weakening. What is the characteristic of this wide range after the breakout pattern? So first thing is that the wide range will go down to test the top of the breakout bars or breakout consecutive bars. For example, here it's testing the breakout top here. And then the second thing is that based on the Fibonacci retracement, it's going to retrace roughly 50% or even more. So this is how we can also tell that this is not a very strong breakout trend. When you see the market is going down to test the top of the breakout bar here, or the market retraces more than 50%, that means probably the breakout trend is over. Here is an example. First, we can see that there is a very strong big breakout to the upside. This bar is huge. That means the upside pressure, and then it is a very good breakout because comparing to the previous bars here, you can see the market was not going anywhere, and suddenly there's a breakout. It indicates that probably there will be the second leg or the third leg. After this huge breakout, the market pulls back, second leg, pulls back, the third leg, and then the market developed into a big range here. This means the market is weakening, and then here you can see the trend is over. But when the market is still developing, how can we tell that the market is gonna develop into a wide range, and how can we tell the market is weakening? Here are the signs. First, when we take a look at the pullback here, you can see that the market goes up, small pullback with this doji bar, goes up, and then another bear bar right away. So there are small two pullbacks under this big pullback. That means the market is weakening. We can see the same thing. After the second leg up, we can see this small pullback, try to go up, and then go down again. There are two small pushbacks within the big pullback. So these are the signs that the market is not strong anymore, and then you want to reset your target if you set it too far above the bull bar here. How do we trade this breakout? After we see this huge upside breakout bull bar, we want to wait for the pullback. Here is the pullback with the doji bar a little bit downward, and then right after the pullback, we want to wait for the signal bar. So here is the signal bar. This bull bar is very huge. The body accounts for over 50% of the whole candlestick, so this is a very good signal bar. However, you can see the market goes down with the next bear bar right away, and if you put your order at the top of this bull bar here, it's not gonna trigger, so you're not gonna get into the market. And then what do you want to do? Wait for the next signal bar, and then next one, you can see this is another very good bull bar, which can serve as the signal bar as well. And then the body, even though roughly 50% of the whole candlestick, but it's leaning toward the upside. So you want to put your order at the top of this bull bar. After it finishes, you can see your order is get triggered, so it goes up for the second leg. After the second leg goes up, it doesn't go much, and then there is a bull bar as a small pullback. So probably the second leg is over, and then you're waiting for the pullback, and if you're expecting the third leg up, you want to trade again. So after this bear bar, you can see there is a bull bar. It's a hammer. So the body is at the top of the bull bar here. It can serve as a signal bar. So after you see this, you can put your order at the top of this hammer bull bar here, and then the next bar, even though it is a bear bar, it triggers your order, so you're in a position. However, the market goes down by 3 consecutive bear bars. Consecutive bear bars means the downside pressure, and it also means the upside pressure is weakened. The trend is not strong as initially anymore, but you can still trade. And then after this small second pullback within this pullback, big pullback, you can see there is another signal bar. This bar is very good because the body accounts over 60% of the candlestick and then leaning toward the upside. So if we want to continue trading, you can put another order at the top of this bull bar, and then it gets triggered, and then it leads to the third leg. Now let's talk about the stop. Stop loss is very important. Whenever you have a trade, you need to have a stop loss, and at the same time to have a profit target set up at the same time. This bull bar is a signal bar, but it didn't get triggered. The second, when it gets triggered, you need to put your stop loss at the bottom of this huge breakout bull bar right away. Even though it seems that it's far away from your entry point, but that's okay. If you put too near to your entry point, when the market goes up and down to fluctuate, it could get triggered and then stop loss right away. So, and then the market will take off. Then previously you could have a winning trade, but now you turn into a lose trade. So initially the stop loss should be at the bottom of this big bull bar. And then as the market goes up and take off, for the second leg here, you can put your stop loss at the bottom of the pullback here. So basically it's the bottom of this doji bar rather than the bottom of this bull bar. For the second leg pullback here, if you enter here, you see the market goes down, you may wonder, am I right to put the trigger here to enter the market again? Yes, you're right. If you get entered the market here with this bull bar, you need to still put your initial stop at the bottom of the first pullback bottom here. And then wait for the market to go up. If the market doesn't go up as expected, goes down to trigger your stop loss, I think you just take the loss because that's the name of the game. But if the market goes down again and then it goes up, you can also decide whether you want to add position at this moment with this good signal bar. After the market takes off for the third leg, you want to move your stop loss from the bottom of the first pullback immediately to the bottom of the second pullback here. How do you set the profit target? For the first pullback, you can set your profit target using the measure move. The measure move means you measure from the top of the first leg to the bottom of the first leg and then measure up from the bottom of the first pullback here, and then the market probably will go there. However, as the market goes on, you need to observe the strength of the market and adjust your profit target accordingly. So in this case, when you see that before it takes off for the second leg, the two small pushback here, so you know the market is not as strong as before, so you want to readjust your profit target to a lower level. And then when you have the trade entered after the second pullback here, probably you don't want to do measure move anymore. Instead, measure your entry point here to the bottom of this actual stop loss, and then measure up by 1 to 2 risk there. You cannot go beyond 2 times of your stop loss for this bull bar here. Otherwise, you can see the market goes down, and then for a very long time it goes up again, but it will never go up to the this point. So you could have a loss if you do not manage your trade correctly. Now let's have a look at the retracement. We measured the bottom of the first breakout bar here, and then to the top of the third leg. And then you can see that 50% is right here, and then coincidentally the market goes down to test this level, because this level is the top of the first bull bar here, or the first leg. And also you can see the second leg here, there are 2 small pushback, and then go up 2 small pushback. So probably when you trade for the second pullback, you can expect 2 small pushback. Normally the pattern will repeat by itself. And then also the pullback is weakening and the second leg is weakening, so you're expecting, okay, so the whole market right now is weakening, so at the top here, whenever there's a small pushback, probably you want to get out of the market right away.